I'd like to welcome you to today's webinar on seed stage investing presented by LocalVest, a platform where investors can find private investment opportunities in their city, state, and region. This is John Bracken. I'm the COO and co-founder of LocalVest. We're excited to share today's webinar topic, which will break down the details around seed investment vehicles, the different types, and the many pros and cons of each. If you have any questions, please chat them to us and we'll try to address them during our Q&A. We will be sending the webinar materials, both the deck and the recording, to all registrants after the webinar. And with that, I'd like to introduce Max Moyer.
Great, thanks very much, John. Thank you for the introduction. Good afternoon, everyone, or morning, depending on your location. As John mentioned, my name is Max Moyer. I'm the founder of Triumph Law, a boutique corporate law firm based in the DC area. Triumph focuses on four things: startup companies, venture and private finance, technology transactions, and M&A. Most of our team are former Cooley lawyers, bringing big law experience training to a smaller, more nimble platform. That's a little bit about us. And without further ado, we'll jump right into the slides. Ooh. Great. So before we get into the specifics of seed investing, let's talk about a few of the trends we're seeing in the venture and angel community specifically. So first thing to note is there is a ton of invested capital. These are updated through Q2 of 2019, but a ton of invested capital through Q2. One thing we're seeing is mega deals pushing VC investments very high and dominating the investment landscape. What we are likely to see is 2019 becoming the second consecutive year with $100 billion invested, which is a huge number. And if you look at historics back to 2009, it is very much an upward trend. Moving to the graphic on the right, another trend we're seeing is angel and seed deal activity dropping. This is measured based on the age of the seed and angel companies, as it now is topping 3 years for the first time, the median age. And we're seeing a general trend for investors focusing on reduced risk, and that's through looking at more mature startups. And overall, the number of deals and the rounds are dropping for the earlier stage investments. Again, keep in mind, some of the deal numbers are going to be affected by the mega deals and skewed a little bit. The other thing we are seeing are valuations on the rise, and you can see back in 2010, valuations for your median Series C or Series B deal have more than tripled from 19 million and seed from 3 to 7 million. Generally, we are seeing a trend that the seed is the new Series A, if you will, and A is the new Series B, whereas 5 or 10 years ago, it would not be unusual to see a $1 or $2 million Series A round. These days, most of those deals would be classified as a seed deal. A couple points here on geography. West Coast has the most deals, no surprise there, and the most money, which is up again from prior quarters. One interesting thing for those in the East Coast, and specifically the Mid-Atlantic, was the 21% of deals by deal count in Q2, and a lower percentage for deal value. Again, the Silicon Valley tends to skew this with large mega deals. But a significant amount of activity happening in places other than the Valley, which is encouraging to see. So what are the trend takeaways? Still a lot of cash out there, a lot of deals being done. As mentioned, these big deals are skewing the count a bit, but it's a healthy investment environment. And so, part of the trend of fewer early stage deals and less focus on very early companies could benefit groups like these that are targeting early stage. So let's jump ahead to seed investing and what it is. So when folks use the term seed investing, what are we talking about? There's both a colloquial meaning and a sort of more specific term of art. The colloquial meaning is it's a tag used to describe really anything early stage, regardless of form, whether it's a note or a safe or stock or LLC interest. And then there's also a more specific term of art for seed, which is a specific class of preferred stock. But we're going to talk about these in more detail. And the seed as its own distinct class of preferred is a trend we've seen develop over the last 5 years or so, where previously you'd have angel investment jumping straight to a Series A. Now there's this carved out niche of seed investment. So let's talk about what that is and what qualifies. So again, under the colloquial tag of anything early stage, you have a few things that can qualify as seed, from common stock, and I would include LLC interests. This is not typical for venture companies, and typically investors prefer additional protections beyond common stock. The other most common that has been around for a while are convertible notes and other convertibles, such as a safe instrument, and these give the holders rights to stock in the future. And then in terms of a specific class of stock, SeriesC.com is a web platform that's really popularized this separate set of documents that is the Series C preferred documents. And then the last category for what can qualify as seed investment are NVCA True. That's the National Venture Capital Association, and they have form documents for a venture round. And often these will be used as is or pared down, and we do see that sometimes with just a smaller dollar figure being called a seed. So jumping right into convertible notes. These have been around for a while, and probably East Coast are the most common form of investment for an early stage company that is not yet doing a priced round. Convertible notes, a few kind of overview points. It is debt, so we're talking about notes. It is debt that converts into stock in the company at a target, often called a qualified financing. And this provides some benefits to the holders at the conversion based on the terms of the notes. The key provisions of convertible notes are a few. So interest rate, because it's debt, it typically has an interest rate associated with the notes. There's often a discount rate, which is a discount applied to the investment that once it converts into shares of stock, that discount is applied. So for instance, if I have a 20% discount on my safe that I've invested, and the company then goes on to raise a price round at $1 per share, I would get those shares at 80 cents a share. That would be the discount concept. The other feature of a convertible note, which has gained a lot of traction recently, is a cap, which can be used in conjunction or separately from a discount rate. But a cap limits how high the valuation can be on conversion. And this came into vogue because convertible note holders may have a 10 or 20% discount on the next round and found themselves seeing a huge jump in valuation from when they invested, which is often very early stage, where the expectation is the company's worth not very much, to a subsequent round where, especially in a landscape of skyrocketing valuations, their 10 or 20% discount doesn't even really begin to approximate the value they would have had if they had tried to price it early on. And so the valuation cap, not ubiquitous now, but definitely shows up with some frequency in a convertible note. And change is one of the benefits we'll talk about in a sec. Qualified financing, what the definition is of a financing that triggers conversion. As an investor holding a note, you are a debt holder and you have some protections there. And when those go away and you turn into a stockholder is an important feature of the note and is often negotiated. and then the maturity date. So at what point, like many loans or debt instruments, there's often a maturity date at what point the note needs to be repaid or converted, and that is dependent on how it's negotiated. Some of the pros, as I mentioned, it's a instrument we see a lot and has reasons for that. It's pretty simple. So convertible notes can be entered with one or two documents, depending on whether you have a standalone note purchase agreement, but also it can be executed with one single document, so it's simple. Initially, the convertible notes, and they continue to be attractive to both early stage companies and investors because you're able to punt until later many of the key provisions that you would otherwise have to negotiate if you were doing a full financing of a price round. And initially that included the valuation. So early on, the discount was the most prevalent form of a convertible note. So for an early stage company, you wouldn't have to negotiate the valuation. For a pre-revenue company, you wouldn't have to come up with all the terms that an investor would be getting. And if you consider the likely universe of investors at an early stage, they may not be venture capital firms. It could be a wealthy aunt or uncle or angel groups or folks that would rather put off some of that negotiating till later. And then the last pro I would say is that they are fairly common, convertible notes, and have achieved some amount of adoption where most investors are comfortable with the concept of what a convertible note is and how it works. A couple of the cons on the company side is accruing interest. So there is an interest number, usually 6 to 7 is pretty standard for a convertible note, which doesn't sound like a lot when you're a starry-eyed entrepreneur and expecting to raise your Series A in a month or two. I have a client that accumulated notes over the course of 4 or 5 years, and that 6 or 7% interest ended up, nearly $500,000 worth of stock that it converted into. So the interest rate can be a con for the company. Similarly, the maturity date can be a drawback for the company. It is not unusual for a startup to expect to reach their Series A price round in a few months, and it ends up being a number of months or even years. So it's very common for startups to run up against their maturity date, and according to the terms of their note, that may mean they technically have an obligation to repay the note holders, which is pretty difficult, if not impossible. So just navigating that maturity date can be a con for an investor. And then, as I mentioned, valuation caps are very common now. So instead of putting off this difficult task of trying to value a early stage, in some cases pre-revenue company, through the valuation cap, you're effectively coming up with a value for the company. And for an inexperienced entrepreneur or even an experienced one, that can be a difficult task. And on the company side, that cap could prove to be punitive if the company does very well. Okay, so moving on from convertible notes to SAFE. What is a SAFE? It stands for Simple Agreement for Future Equity. It was developed by Y Combinator out in Silicon Valley, which is a well-known incubator, and is an agreement designed to be a turnkey document for founders and startups to raise money without going through jumping through some of the hoops that they otherwise would have to, and incurring legal costs and time negotiating a full set of documents. So that is how the SAFEs came to be. They are similar in how they work in a lot of ways to a convertible note and share some of the features of a convertible note, but also have some important distinctions. So the key provisions, like a convertible note, there can be a discount or a cap, and sometimes both. And the new version of the Y Combinator SAFE is a post-money SAFE, which is slightly different in terms of how it calculates ownership. suffice it to say, for an investor, if you invest in a post-money safe, you know exactly what percentage of the company you will own immediately before the next financing, which with the standard convertible note with a discount or even a cap, you have to go through some fairly complicated cap table math at the time of financing to even understand exactly how many shares you own as an investor and what that means. So the post-money safe pegs that value immediately before closing and provides the investor with a set percent of the company they own based on the investment they have and the cap. So let's look at some of the pros of the safe. So like the convertible note, they're simple and maybe even more simple because there's a turnkey form that can be downloaded from Y Combinator's website, blanks filled in and you're done with some authorizations on the company side. One of the key features that makes it attractive to startups that I mentioned with the convertible notes is there is no interest accruing on the safe, and it's not a debt instrument. So on the flip side, for an investor, being a debt holder is nice because if there's a liquidation or winding up of the company, as a debt holder, you have priority over the equity holders. The safe is true equity, so it's not a debt instrument, it's not accruing interest, and it doesn't show as any form of debt on the books. And as mentioned, it's a easy plug and play document. So what are the cons of the safe? It's not ubiquitous. In the East Coast specifically, while it's gaining a lot of traction on the West Coast, it's still not unusual to find investors who have never heard of it and are leery of using anything they're not familiar with, and not without good reason, because the plug and play may not be a perfect fit for all investors. Different investors have different appetite for deal terms, and for that reason, there is some risk for investors if they're not debt holders. They don't have the extra layer of protection, and without a maturity date, there may not be a forcing function the same way that a note might have. And then back on the company side, dilution for founders. So that post-money safe, the post-money safe form does incur a bit more dilution for founders than either just a discount or the regular cap. So that's a quick overview of the convertible notes cousin, the safe. So SeriesSeed.com, as mentioned early on, there is a term of art for seed, and that's captured in the documents on the SeriesSeed.com site. So these are SeriesSeed.com. When we're talking about what is seed stock, in a specific sense, it is preferred stock. And the idea is the NVCA documents are extremely nuanced, detailed, expansive, but investors who want preferred stock may want to be able to get in and out of a company in a more simplified and streamlined manner. So SeriesSeed.com was born, and the idea here is to give something simpler than NVCA, but still offer preferred stock. It consists of two agreements. There's an investment agreement and there's certificate of incorporation of charter. The charter is filed with Delaware, and that is the state of incorporation. That's the document that will actually create the additional class of stock and assign its rights. And then the investment agreement contains a number of different terms that are going to be some of our key provisions in the Series Seed. So what are those? What are those key provisions that are negotiated and decided in the seed documents? So first off, because it is preferred stock, it is a price round, there is a valuation term. So understanding what the stock is worth is a requirement for Series Seed. That will also then go hand in hand with the economic rights that the seed holders have. So as preferred stock, there's typically a liquidation preference. By and large, at a seed stage, what is most common right now is a 1x non-participating preferred liquidation preference, meaning there's downside protection for the preferred stockholders, but it's not overly burdensome on the company. Dividends are not part of the core seed.com documents, but sometimes they work their way in if you see a blended form of agreement. And then the other key piece of the provisions that need to be incorporated in Series Seed and negotiated are participation rights. So whether the investors are going to have the ability to participate in future rounds. Like most preferred stock, there are protective provisions, which is stockholder approval rights or block rights on a number of key matters. And then in the investment agreement, there's the ability to name board members from the investment group. So those are some of the key features. Again, it's a streamlined set of rights and preferences compared to a full venture round. So one way that the seed documents get around this is this concept of future rights, which in the investment agreement give the investors the rights that they would have in the next round based on whatever those negotiated rights are. And the idea there is we're going to get comfortable as investors with a more simplified set of protections and rights, in part because we know at the next round, when these are fully negotiated, we will benefit from those rights. Pros of the SeriesC.com documents is we're moving a little more toward from the general to the specific. So unambiguous in terms of what I own, what the share price is, what happens if we exit. The documents are fairly streamlined compared to a full set of venture documents. As mentioned, there's two key documents in the investment agreement and the charter. The investment agreement, by the way, doubles as sort of a purchase agreement, stock purchase agreement, and investor rights agreement. They're mashed up in there. So it is fairly streamlined and also fairly protective in that as preferred stock, you're negotiating some of the core rights that the investors tend to care about. On the con side, as compared to a safe or promissory note, it is more involved. You are filing with the state. You are creating a new class of stock. Most companies will need to lean on legal support to get the documents done. And so there is a level of sophistication that for a brand new startup may be a little overwhelming. And then also, again, SeriesC.com, they are designed to be user-friendly. A lot of the format of the documents look different than, for instance, the NVCA documents do, with a lot of defined terms up front. Again, in a way that's meant to be very user-friendly, but if you haven't used them or worked with them before, then it can be a little bit off-putting to the investor. So that would be one of the cons of the Series Seed. And then the other category you see sometimes lumped into preferred are true NVCA documents. So when talking about the NVCA, again, that's the National Venture Capital Association. If you go to nvca.org, you'll see the documents they have available. And these are annotated versions of 5 documents that constitute the core for most Series A and beyond venture rounds. Stock purchase agreement, amended and restated certificate of incorporation, that's the charter, voting agreement, investor rights agreement, and right of first refusal, and co-sale agreement. So we do see those out in the marketplace. Again, we're talking about price round, there's valuation, a number of economic and governance terms to work out. You start getting into registration and information rights with a full set of documents. So while this provides some additional flexibility for investors to be very specific and nuanced on their rights, and they can be pulled back and streamlined to be more simplified and easier to adapt. Overall, it's usually overkill. And so usually the cost and complexity of using NVCA docs for a deal that is under a couple $1 million will be prohibitive, especially when there have evolved new, more attractive and streamlined versions like the Series C. But I want to mention, because we do see it sometimes. So with that, that's I know a lot of material we covered and kind of a crash course on the different forms of investing, but we, at this point, I think we'll open it up to any questions.
Great, thank you so much, Max. So if anybody has a question, feel free to pop it into the chat box. In the meantime, we have a few questions for you already. And the first question is, what happens when a convertible note reaches maturity? Does the company have to pay out all the investment?
Sure, great question. So I touched on this, mentioned it a bit, but a convertible note has a maturity date, and often over the course of time, a startup will enter into a number of different maturity dates. The typical timeline for a note is 12 to 24 months. So if you have 18 months before you hit your maturity date, as expected, a lot of startups won't get there and won't have raised their Series A before hitting that maturity date. So if you are a startup and have raised $500,000 on notes that are supposed to convert and by their term require repayment at maturity, that can present a problem for the startup. I would say what I tend to see happen most often is a startup gets to that point and kindly reaches out to the investors to ask them to amend the notes and push that maturity date out for two reasons. One is the investors who have put in money in an early stage company may not have the appetite just for a 7% return. That's not why they invested. And then the other is, on a more practical level, the company can't pay $500,000 if they haven't raised money in their early stage. So it is a pretty common way to handle that.
Great, thank you, Max. We just have a question from Wes Lloyd, and is, what typical diligence do you see for seed stage investments?
Yeah, thanks for the question. So it's all over the map, and it depends mostly on who the investor is. So because both the term seed investing and the actual form tends to apply to a wide range of investors, the rich aunt and uncle probably don't even really know what the word diligence means in some cases. And the angel group or the micro VC could treat it like a full-on venture round in terms of diligence. I would say most typically it is going to be determined by the counsel that the investors have. I always recommend making sure you know what you're buying in a few different areas. Capitalization, intellectual property, and on the employment side as well, and tax would be the other. But there's a few key areas. So I always recommend doing a little bit of diligence. I would say practicality, just based on the way these things unfold. Sometimes there's very little diligence done, and sometimes it's diligence to death over months and months.
Great, thank you. Okay, one more question from Mark Baldino. What ways do investors know they own traditional shares after purchasing, other than a canceled check?
Yeah, good question, Mark. So this landscape is also changing a little bit. I have not printed and mailed a physical stock certificate since I opened my own practice in June of 2018. Which used to be the way it was done, right? You would have a physical certificate signed by the CEO and the secretary, and it would show up at the closing date. If you're buying shares, so not a safer convertible note, typically either you just hold on to your executed document, but I would say we're seeing more the advent of online cap table management. Sites like CapShare or Carta.com is a very common one, and they're electronically generated certificates. So with the clients I work with, I do like Carta.com, and so a lot of them will use electronic certificates. But then also just having having the executed documents in the case of the safe or the convertible note, that's all you'll have anyway. In the case of a true price round, it's not unreasonable to ask for additional documentation. But stock certificates aren't treated quite the same way as they used to be for early stage companies.
Great, thank you. Another great question from Bradford Bonnie. For an instrument like a safe that are supposed to be boilerplate, how common is it to negotiate specific terms beyond the discount and the cap? And other than discount cap, are there key terms that an investor should keep an eye out for that is particularly beneficial or harmful?
Sure, thanks for the question. The safe, as I said, is set up as a template and even has a provision in there that says nothing has been changed in this document from the Y Combinator form other than filling in the blanks. So one of two things happens. Either that is left in there and all that's changed is filling in the blanks, and then there's the document really tries to strike a balance between company and investor favorable terms, or it's negotiated, and I see both. It's typically the more sophisticated investors that know what they want, especially as it may change from the standard that will negotiate it. And in terms of what can be added or changed, there are a few different things that you can put any bells or whistles in the safe agreement, from ongoing participation rights, information rights, audit rights, financials, things like that, to mimic some other form of agreement. In terms of what is investor favorable, I would think about it in the reverse, which is with no interest rate and no maturity date, what happens if no shares are raised or no secondary financing is raised in 12 or 24 months? That's one of the risks as mentioned in the safe. And then again, the other thing I see is just sort of investor specific requirements that they want more protection, more visibility, more control, more rights than is baked into the safe.
Great. Let me ask one more question, and then we'll try to wrap it up here. So you mentioned East Coast versus West Coast a few times in your presentation. How does the geographic region affect how seed deals work?
Yeah, thanks for that. So, and that's a bit of a simplification. We looked at the map earlier, and there are deals happening all over the country. I recently talked to a guy who runs an incubator in Nebraska, and the sense of the companies he's forming are all Nebraska LLCs, which is a totally different format of the standard Delaware C Corp that you'll see a lot of other places, including in the Valley. But I think it's just important to note that different investment cultures crop up different places, and this is an oversimplification, but broad brush, there's a lot of in the Valley, a lot of sort of big idea investing without scrutinizing or beating the company down with too many punitive terms, where the sort of characteristic East Coast investor may want to put in more protections and more more downside protection, things like board flips if the company hasn't sold after a certain amount of time, things that tend not to be, again, at a high level scrutinized as much at the West Coast. And then in between, there's different pockets, I would say, of investment quirks, depending on who you're dealing with and where they typically operate.
Great, I think that's it. So thank you, Max. That was great. We hope everyone enjoyed today's presentation on seed stage investing. If you'd like to connect with Max directly, please find him on his website, triumph.law. And on behalf of Local Vest, I'd like to thank you for joining us today to learn more about investments. At Local Vest, you'll find local and exclusive investment opportunities in tech, real estate, and more. Local Vest is a platform for accredited investors to find investment opportunities, connect with other investors, and to join an investor group that matches your interests. So you can feel free to reach out to me. My email is john@localvest.com. If you have any questions, I'd just love to chat. Thank you so much.